In this example video, we're going to be looking at journalizing business transactions. One of the key things to remember is that you are provided a chart of accounts. It's located here as well as in this separate tab. If the account name is not listed in the chart of accounts, it cannot be listed as part of your journal entry. So please always refer to your chart of accounts when you are journalizing. As a reminder, we have some very important rules regarding journal entries. Number one, there has to be at least 2 accounts involved with each transaction. Second, any account that's being debited for any reason is listed first, followed by any account that's being credited, and your debits and credits always have to equal. When you're looking at business transactions, look for keywords, phrases, and account names. Many times the transaction will list either one or both of the accounts that are being affected in your transaction in that transaction information. So really pay attention to the wording that's provided. So the first one we have is on October 1st. It tells us that we paid rent for the month of $2,200. Paid means that we paid something in cash. We've spent money, so we know our cash account is going to be involved, and what we're paying for is rent. So we have a rent expense account for $2,200. Remember, our expense accounts are always increasing, so they're always debits for us. And again, they said we paid it. Paid is in cash. Cash is an asset for us. When we spend money, we have less of it, and that decreases with a credit. On October 3rd, it says again, we've paid for an advertising expense of $550. So anytime you see paid, you know cash is involved. We're spending out cash, which means cash is decreasing. Cash is an asset to our business, so it has to be credited. And what we are spending our money on, what we're spending our money on is an advertising expense. So we look at our chart of accounts. We do, in fact, have an advertising expense account, so that is what we are going to debit. Because remember, our expenses are always increasing. And our cash is decreasing. On October 5th, it says again, we've paid cash for supplies. So paid we know is in cash. Cash is even listed in this transaction, and what we're spending our money on is supplies. So we see both accounts that are being affected in the transaction listed in the transaction. So in this case, we're swapping one asset for the other. So we have a supplies account. Remember, supplies are assets when we've purchased them. They do not become an expense until we've used them. And our cash is also an asset, but our cash is being reduced. On October 6th, it tells us that we've purchased office equipment on account for $9,300. So office equipment, we do have an office equipment account. When we purchase that office equipment, it is an asset to our business. When we have more of an asset, we increase the account with a debit, and we've purchased it on account. So anytime you see on account, that means it's either dealing with accounts payable or accounts receivable. So on account, notice out of all of our chart of accounts, there's only 2 that have the word account in the title. Accounts receivable and accounts payable. When we have an account and we've purchased, that means that we have an accounts payable. We're going to have to pay for our purchase sometime in the future. On the 10th, it says that we have received cash from customers. There's that phrase again, on account of $16,950. So again, look, paying attention to wording. We're receiving cash. Cash is an asset account to us. When we receive cash, we have more of it, which means we need to increase our cash account, and we do that by debiting the account. We've received cash, why? From customers on account. So again, when you see the term on account, think about what we're doing here. So on account, last word is account, first word is received. That means we're dealing with an accounts receivable. We have finally received the money that we have been waiting to receive from our customers for services that we have already provided to them. So again, we're swapping one asset for the other. Accounts receivable is a holding place for cash. We're waiting to receive that money sometime in the future from our customers. On October 15th, they tell us that we've paid our creditors on account. So again, we see that really important phrase of on account. So when we're trying to determine whether it's accounts payable or accounts receivable, on account, last word is account, first word is paid. That means we're dealing with an accounts payable, and we're paying creditors. Creditors are who we owe money to. So that's dealing with an accounts payable that's going to be decreasing, and we pay everything in cash. I'm going to enter in October 15th. Again, we want to reduce our accounts payable because we're making a payment. So our accounts payable is going to get reduced with a debit. So we debit it for $3,000, and we've paid, so we credit cash for $3,000. On October 27th, it says that we paid cash for miscellaneous expense. So both the accounts that are going to be affected are listed there. Cash is going to decrease because we're paying it out. Miscellaneous expenses increasing. Remember, our expenses are always increasing, and therefore they are always a debit for us. So we're going to debit our miscellaneous expense for $520 and credit our cash. On October 30th, it says we paid a telephone bill for the month of $325, and it tells you to use utility expense because if you look at your chart of accounts, we don't have a telephone expense account, so we can't put something in there that doesn't exist in our chart of accounts. And again, we paid for it, so we know our cash has to be being, and our utility expense, they tell us, for our telephone is for $325. And we have our cash for $325. They then tell us on the 31st that we have earned fees, and it says we're billing our customers, which means our customers are not paying us cash that day. We're going to be receiving that money sometime in the future. So we debit our accounts receivable, which is an asset account, which is representing how much cash we expect to receive sometime in the future because we've already earned it. Remember, we record our revenues when we have in fact earned them. We also have another transaction on October 31st. We're paying that electricity bill, and again, we're using our utilities expense of $860, and we paid it in cash. And finally, it says they made a withdrawal for personal use of $1,500. So looking at our accounts that we have Jason Payne drawing. And just like our expenses, our drawing accounts are always increased with a debit of $1,500, and they withdrew the cash of $1,500.